I think there's a global concern that particularly impacts banks because the economy is very important to their success. And we got Saudi Arabia, we got Italy, we got tariffs, and that uncertainty isn't good for financial institutions. I think there is concern about loan growth, but I think people are forgetting that a very major thing occurred that affects loans by banks. And that is the reduction in the corporate tax rate, which obviously puts more cash in the corporate bank, if you will, in the corporation, and also bringing back the overseas deposits that were tax related. That needs to be used before you're going to see a big jump in loans, and I think that will occur next year as all of these things are being used for capital goods, for acquisitions, for dividend increases, for stock buybacks. And so that's kind of a one-time 2018 issue that has reduced what would be better lending because the economy is doing so well.
Right. It's a little strange, isn't it? I mean, we're so flush with cash that we don't need to take out credit, and as a result, I mean, it's probably not a trade that people saw through at the beginning of end of last year.
Correct, but it's also good. I mean, it's good that people are making more money and so on, and that will add to their investments and capital goods and jobs and so on. So it's just a one-time negative for the banking industry, but will be more than made up for it if we continue to grow the economy and people buy homes and buy cars and corporations invest.
So, Dick, it sounds like you're saying that broader economy-wise, there's plenty of dry powder in 2019 because there's going to be capital available for those who want to try to grow.
No question about it. Both capital markets and banks. Banks are highly liquid, and it's there. And at still relatively low rates. I mean, we got the president complaining about rates. These rates are still remarkably low from a historical perspective. And I think he's wrong. I think we need to get to a neutral rate. And I think the Fed is doing an excellent job.
Dick, I have to get your thoughts on comments from FDIC Chair McWilliams earlier this week, suggesting that as we've seen more regulation on the banks, that the risk has shifted from banks to mortgage servicers and non-bank lenders. Do you think that's true?
I really don't know that, but it wouldn't surprise me because the non-bank lenders are gaining market share because they simply don't have the regulations of banks. And I think someone should be looking at that because, in my opinion, if there is an issue relative to the financial side, it's much more likely to occur on the non-bank side than on the banking side, which has lots of capital and has been used to this regulation. And as I said, the banks are losing market share because the non-banks are not regulated as much.